particular chapter is on investments, so we're going to delve into the balance sheet, and we're also going to talk about how this can affect the income statement. So even though investments are assets, when we actually have increases or decreases in them, later on we'll talk about mark-to-market accounting or fair value accounting. That may affect the income statement as well. So the first thing to note is when we're talking about investments in general, we have two different types, two different ways that an entity can invest in a company. One way is to become a creditor of the company. So the company will issue bonds or notes payable, and someone will lend the money to the company for those bonds or notes payable. So those are known as debt securities. That's when the investor doesn't become an owner of the company, they're just a creditor. The other way is a more common way that people are familiar with investments. This is through equity securities, which is basically another term for stock. Here we're talking about common or preferred stock. We're talking about an entity or an individual buying into the company. They are now owners of that company. They've invested their money, and the way they make money back is by the success of that company. A creditor, on the other hand, they really, if the company is successful, that doesn't really help them all that much. They get their interest back, and that is it. There's no real upward potential. There's less risk for a debt security for a creditor because they get their money first before the equity security owners get their money. So we have a few different ways we're going to talk about reporting for these investments. We're going to talk about a situation where the investor lacks significant influence over the operating and financial policies of the investee. So in other words, all they're doing is they're just investing a little bit of money. They don't really have significant influence. They can't control the company. They're just investing a little bit of money. Then we'll talk about a situation where the investor has significant influence over the operating and financial policies of the investee. So now they're not just a minor investor, they're a major investor. We're going to talk about when they own between 20 and 50%. They don't have full control over the company, but they have significant influence. And then we'll talk about a situation where the investor actually controls the investee. To do this, you have to own more than 50% of the company, and then you become the controlling owner, if you will. So now we're going to start off in a situation where the investor lacks significant influence. We have three different methods we're going to talk about here: held to maturity, trading, and available for sale. When we have a held to maturity situation, this is where there's an intent, and there's the intent and the ability for the company to hold that debt to its maturity date. So they don't plan on selling it anytime soon. They're going to hold the loan to its maturity date. Now the thing here, notice it's just for the debt securities. It's not for equity securities. The reason being, there is no maturity date for an equity security. There's no point in time where that security becomes due and you get all your money back. You own the company until you decide to withdraw from the company. So you cannot hold equity to maturity because there is no maturity for equity. Debt, there is a specific date. Could be 5 years, 10 years down the road, but there is a specific maturity date. So that's the key thing to note there. Held to maturity is just for debt. We are not going to recognize any unrealized holding gains or losses. The reason being, we don't expect to realize them anytime in the near future. That's the reason. With these other two, trading and available for sale, we understand that at any point in time we could get rid of these, we could sell these. There's no intent whatsoever to keep these for a long time. Therefore, at any point in time, we can truly realize the gains and losses. Because of that, we want to keep that kind of up to date. We don't want to be surprised at some point in the future when we finally realize it. We want to actually recognize this. For instance, for trading, we're going to recognize this in net income every period. And it's going to become part of retained earnings through the net income. So in the balance sheet, remember I told you we're going to talk about both sides, the income statement and the balance sheet. On the balance sheet side, for both trading and available for sale, we're going to find that we're going to record these at fair value. Sometimes you'll hear this referred to as mark-to-market accounting or fair value accounting. This is one of the exceptions to our normal historical cost principle. Normally when we purchase an asset, we record it at the historical cost, and it stays there until we sell it. For instance, if we purchase a building, we're not going to adjust that building's cost every year. We're not going to adjust it up. We're not going to adjust it down. We leave it at historical cost. Investments are treated differently because of their very nature. In this case, we intend to sell that at any point in time. That's one reason. The other reason is we can identify a very good fair value. Just go out on the market, find out what that particular stock or that bond is worth, and there's your fair value. With assets like buildings and equipment, it's not quite so easy to identify that cost every single year, or that value every single year. So that's the big difference there. Trading, again, the key thing here is we are actively trading. We're buying and selling very short term. Available for sale is kind of the catch-all. If we can't consider it held to maturity, but we're not really actively trading it, we're saying, hey, it's available for sale. If someone wants to buy it, someone gives us the right price, then yeah, we'll sell it. But in this case, we're just kind of holding on to it for right now. So available for sale is kind of the middle ground, if you will, and it's when a particular security doesn't meet one of the other two requirements. Now, the treatment, it's still going to be reported at fair value in the balance sheet, but here we're not going to record it directly into net income itself. Instead, we're going to put this in something called Other Comprehensive Income, OCI, and it's going to also, that's on the income statement, that's part of the comprehensive income. It's after your core income statement. There are a few different things that go in there. This is one of them. And since it's in Other Comprehensive Income, every year we're going to take the sum of all that other comprehensive income throughout the life of the company, and it's going to be recorded on the shareholders' equity statement as accumulated other comprehensive income. So the keyword there is accumulated. It could go up, it could go down from period to period. Very similar to retained earnings, only it's for the other comprehensive income. So now let's talk about securities that are held to maturity. Again, these are when there's a specific maturity date. The only time you can have that is when there's a bond. So earlier I talked about the intent and ability to hold those securities to maturity. In other words, you don't need the cash right now. You can hold them, and that's the intent of the board of directors, is to hold them. We're going to report these on the balance sheet at amortized cost. So whatever, if we have a discount that we're amortizing over time, that's where the amortized cost comes into play rather than just the actual original cost. That amortized, it could be a premium or a discount, that will change the value on the balance sheet. It'll bring it closer and closer to the face value over time. For instance, if it's a premium, if you go back to bond pricing, if it's a premium, our amortized cost in year one is going to be much higher than the fair value. In year two, or face value, I'm sorry. In year two, it's getting closer and closer to the face value. Year three, even closer. Year four, even closer. So that's the case there. And that's exactly what it's saying in this bottom bullet point as well. So here we have a situation here, and again, this gets back to bond pricing. On January 1st, 2011, Matrix Incorporated purchased as an investment $1 million of 10% 10-year bonds where the interest is paid semi-annually. The market rate for similar bonds is 12%. So we know we're going to have to issue this at a discount. We're only paying 10%, or actually well, the company that's issuing this is only paying 10%, where we can actually get bonds on the open market right now for 12%, 2% higher. So what we're going to do there to price that, they take the interest payments and they find out the the present value of the annuity, which they just pull the factor for 10% and 10 years, or actually be 5% and 20 semi-annual periods. But they pull that particular, oh, I'm sorry, 6%, because the market rate is what we use there. So 6% and 20 semi-annual periods, that's where they get these present value factors. multiply one interest payment, not the full amount, just one interest payment, times that present value factor. That gives us the present value of the annuity of all these interest payments over time, what it's worth today if we were bringing it back to present value. And then we take the principal and we do pretty much the same thing. We take $1 million face value. That's going to be in 10 years or 20 periods. So we want to find out what it's worth today. What's the present value? So again, we find the present value of a lump sum, 20 periods, 6%, and then we multiply those two together to get $311,805. Over in the total amount is $885,000. So you can tell that that bond was issued at a pretty decent discount. Instead of issuing it for $1 million, it was only issued for $885,000. So again, that should be somewhat of a repeat, nothing tricky there, just kind of walking through it. Here's how it's amortized over time. You can see that each period has a little bit, but it's going to be amortized. It's going to get closer and closer to the fair value, that carrying value, or that amortized cost. That's another term for carrying value. It's going to get closer and closer to the $1 million fair value. So the entry on January 1st, 2011, when we first purchased it, we have to plug it in our investment account at $1 million. That's the face value. We only gave up $885,000 of cash, so that gets credited there. The plug figure is the discount, and over time we're going to take this $114,000 and amortize it over each period. On June 30th, when we get the first payment, we debit cash for the actual interest we've received. That's always going to be $50,000. That's just going to be the flat $1 million times the 5% interest rate for that period. So it's going to be $50,000, and we know that we're going to have investment revenue. That's the flip side of interest expense. If we were issuing these bonds, we would have interest expense every period. But since we're actually investors, we're owners of this bond, we're getting investment revenue instead. So in this case, it's going to be more than the actual interest payment we received. It's going to be more than that $50,000. The difference is going to be that $3,000 that we're amortizing each period. And here's how it looks on the books. We have the face value of $1 million, less discount on bond investment, which is going to change over time. It's going to decrease. And then the book value is going to be amortized cost, which in this case it's $888,000. Now, as I mentioned earlier, for held-to-maturity bonds, because it's only for bonds, we're not going to recognize any unrealized gains or losses. So even though the value of this may go up and may go down, since it's got a long-term intent, we really don't expect to cash this in for 10 years or so. Pretty much says that we don't need to recognize that. It's not an urgent issue. And you can see that's going to change each period. Here we have on December 31st, 2011, after the interest is received, all the bonds are sold for $900,000 cash. So the first thing we have to do is use our normal entry, our normal investment income entry. And then that updates our books so we can record the sale immediately after that. Here they said they're going to sell it for $900,000 cash, so we debit cash for $900,000. We credit the face value of the investment bonds to get that asset off of our books. That's $1 million. We debit the discount that remains at that point in time. Keep in mind, we've updated this to that year. So it has a credit balance. We have to get that off of our books, and that's going to be $108,276. So that gets that off of our books. The plug figure here is going to be the gain on sale of investments, and that's going to be, in this case, a credit. We know our debits and credits have to match. That's going to tell you whether you have a gain or a loss. So what we've talked about at this point is held to maturity. Now we're going to talk about trading securities. So these are where our entire purpose is to sell these things right away. We're buying them very short term and selling them. So they're trading securities. This can be debt or equity. So what's going to happen here is, since it's short term, we do want to keep track of the unrealized gains or losses, and we want to actually recognize them there. So what we're doing here is, first of all, the adjustments to fair value. It could be up, it could be down over time. We take a look at what we're recording the asset at today at the end of the period, and then we compare it to what the actual price is. What's the fair market value on the market? We compare those two, and we either adjust it up or we adjust it down. So we have that fair value adjustment, and it's going to go straight to, well, there's two ways to do it. Let me put it that way. We could have an actual valuation account, which basically is either, you can consider it an adjunct account or a contra account. They generally consider it an adjunct account because it adds to the fair value, or it adds to the actual cost basis of the investment. So since it's an adjunct, and we're talking about an adjunct investment account, normally that would be a debit balance because it's going to add to another debit balance. However, there are some times when that valuation account, if you have a bad year, mark to market may mean that we've dropped that cost down to a very low value, fair market value. A lot of companies probably experienced this within the past couple years, when a lot of the stocks or debt securities lost their value. So what I'm trying to say is, this valuation account, it can also have a credit balance, which would reduce your overall asset. So it just depends on the economy and that particular investment. But in any case, that's where we put it on the balance sheet side. You could do it that way. You could have it as a separate valuation account, or you could just directly adjust the actual asset itself instead of messing around with an adjunct or a contra account. Now that's the balance sheet side. The income statement side, we're going to call it a net unrealized holding gain or loss on the income statement. So here we have an example. Matrix Incorporated purchased securities classified as trading on December 22nd, 2011. The fair value amounts for these securities on December 31st are shown below. Now they want us to prepare the journal entries for Matrix to show the purchase of the securities and adjust those securities to fair value at December 31st. So I have a few different things. They tell us the number of shares, the unit cost, and the total cost at December 22nd. What we're really concerned with is the total cost there. If you look at 12/31, you'll see that both of those investments lost value. They went down by 1,000 and 2,500 respectively. So that's going to be the unrealized gain or loss. We don't actually realize it until we make the sale and it's there. But in this case, since it's a trading security, we want to constantly record this because we know at any point in time this could be sold. We don't want to fool investors by saying, oh, no, everything's going great, and then all of a sudden when we sell it right away, there's a huge loss that was hidden before. And it could work in the company's favor also. It could be an unrealized gain, but in this case it's a loss. So first of all, the purchase itself, we have two different investments. We're going to debit them both. They're both assets for their respective purchase prices. We credit cash for the total because that's how much we had to pay. And now, again, we could use a fair value adjustment or we could directly go to the asset. In this case, on December 31st, we're using a fair value adjunct account or a contra account. Again, it's usually an adjunct account. In this case, you can see it has a credit balance instead, so it's almost acting like a contra account. It's offsetting the asset's value. So here, for that entry, we debit what we're going to call net unrealized holding gains and losses on the income statement, $3,500. That was the total. And then we credit that fair value adjustment, which reduces the assets. And here you can see they're calling it an adjunct account, even though it's not really adding to it. It's subtracting from it because there's a credit balance. So now on January 3rd, they sold all those trading securities like we expected them to for $65,000 cash. Let's record the entry for the sale and the adjustment to fair value. So first of all, the sale, we debit cash for $65,000. That's how much we received. We credit both of those investments at their particular historical cost basis, because keep in mind, we didn't directly adjust the investment accounts. We used that separate fair value adjustment. So because of that, these numbers have remained the same. So we're going to credit them for their respective values. And if you do the math, you notice that we have a gain overall, $500. So apparently what happened is it looked like we had a loss. If we would have sold this a week earlier or a couple weeks earlier, we would have had a loss. But for whatever reason, after the new year, the value increased again. So we ended up overall with a gain. So what's going to happen here is we're going to debit fair value adjustment for $3,500. Now let's go back a bit. Remember, that's the amount that we had originally. So we're not changing that amount. We're debiting fair value adjustment for $3,500, crediting the net unrealized holding gains or losses for $3,500. All we're doing is closing these out. These were temporary type accounts that were just intended to approximate it. Now we have, once we close these out, we have overall our $500 gain. That's the only thing going to be left on the income statement because these are gone. So as far as where do these trading securities go, we talked about how the fair value changes for trading securities go straight to the income statement. They do not go to other comprehensive income. So they're going to go directly to the core income statement, not that supplemental portion. Later on, we're going to talk about a security that goes there. It goes to the other comprehensive income rather than the normal core income statement. The balance sheet, again, the securities are reported at fair value right on the core part of the balance sheet. They're not going to affect that accumulated other comprehensive income, which is part of shareholders' equity. Again, that's going to be another type of statement altogether. That's the available for sale that mess with those comprehensive income portions. And the cash flow statement, we haven't talked about this much, but anytime you buy or sell trading securities, we're basically saying this is part of your operating because, again, you're not really truly investing. You're just buying it, selling it, buying it, and selling it. So that must, if you do it so frequently, that must be a big source of your operating funds. If you hold trading securities to maturity, it's going to be considered investing. It's not going to be an operating activity. And here's just a show of how the income statement would look. Again, the key thing here is we have realized and unrealized gains and losses, and that's the thing to point out. Remember, we had one actual gain that was realized. That was for one investment. We very well could have another investment still on the books that we haven't sold yet, so we're going to have unrealized gains or losses there. That being said, you don't necessarily have to report these together. You could separate these out. It doesn't matter as long as they're both there. Then again, the trading securities are a current asset, and the cash or the purchase of trading securities was a cash outflow. And when we sold them, that was a cash inflow. So that's trading securities. We've talked about held to maturity, trading. Now we're going to talk about the third category, securities that are available for sale. The key thing here is this is a catch-all. If you have a debt or an equity security that cannot meet the requirements of held to maturity and cannot meet the requirements of trading, then it falls into this catch-all bucket of available for sale. Now, again, it's kind of a hybrid between the two. We do recognize the actual adjustments to fair value, but they do not directly affect the income statement, and they don't directly affect the balance sheet. Instead, they're in supplementary portions of those. So what happens is we look at the adjustments to fair value. We still use either our valuation account or directly adjust them, and that's how they're recorded on the balance sheet side. But as far as the income statement, again, they don't directly affect the net income. Instead, we put them in other comprehensive income, and that's going to flow over. Instead of going to the balance sheet, it's going to go to accumulated other comprehensive income on the actual statement of shareholders' equity. So that's going to be, again, it's all kind of supplementary information. If you hear the term comprehensive income, in either of these cases, you know you must have available for sale. So here's what other comprehensive looks like. Again, this particular issue, there are a few different things that come into play. You have foreign currency translation issues. We have these ones, the net unrealized holding gains or losses on investments. If you have pensions, you have any adjustments upwards or downwards there. And then that's those are the big ones, those first three that we're going to see. That gives you the total other comprehensive income. That just gives additional information to the shareholder. They understand that this stuff hasn't happened yet. It hasn't been realized, but we need to keep track of it because at any point it could be realized. And then here's the other accumulated other comprehensive income. Again, we have the statement of shareholders' equity. We have our common stock. If we have preferred stock, we'd have that there as well. Paid in capital in excess of par for either common or preferred stock. We have our accumulated other comprehensive income. We have our retained earnings. Now keep in mind, if this was a trading security, it would go to the income statement, then it would go straight to retained earnings. But since it's available for sale, it bypasses the income statement, instead just goes to this accumulated other comprehensive income. That gives us total shareholders' equity. So let's take a look at a similar example where we're going to sell these particular available for sale securities. Same dollar amounts for everything. The only difference is now the net unrealized holding gains or losses, they don't go to the income statement. Remember before it said IS? Now they're going to other comprehensive income instead, which is in the supplemental portion of the income statement. We still have our fair value adjustment on the balance sheet, $3,500. So now we're still talking about available for sale. Now, key thing here, earlier under the trading securities, we lumped realized and unrealized together on the income statement. We said that we could separate them, but for this purpose, we lumped them together. Now, under the available for sale, remember that the unrealized gains or losses don't even go to the income statement. Instead, they go to OCI, other comprehensive income. The realized gains or losses, however, they do get put in net income in that particular period when they're sold, because at that point we've actually realized them. Therefore, we have to recognize them on the income statement. The balance sheet, again, pretty much the same thing here. The investments in the available for sale, they're going to be reported at fair value. The unrealized gains and losses are going to that shareholders' equity statement instead of the balance sheet there. And when we do finally sell them, we take them out of the accumulated other comprehensive income, and we'll adjust the balance sheet at that point when we actually sell them. Now here, again, as I said, held to maturity and available for sale securities, on the cash flow statement, they're classified as investing because we're not actively trading them. It's not part of our operations. It doesn't happen every single day. So therefore, it's not going to be operating now. It's going to be investing because that's the kind of the primary purpose. So here's how this shows up. The only big difference is the realized only is on the income statement. The unrealized is in this supplemental section of the income statement, the other comprehensive income. And really, same thing with the balance sheet. We have those listed as a current asset, and now under the cash flows, we have it as an investing activity instead of a operating activity. So everything's all fine and dandy when we keep things in one particular method, but now we're going to kind of complicate that. We're going to say that we're no longer treating these as trading. We're going to treat them as held to maturity or vice versa. We're going to switch them between the categories. So what happens is when we transfer from either available for sale or held to maturity to the trading category, we have to take that unrealized gain or loss. We have to calculate it first of all and take that unrealized gain or loss and include it in the current net income. The reason is trading securities are handled under the net income, so whatever fair market value adjustment we have at that point, we're going to take that straight to net income as well. Basically, we treat it under the same method that we would normally treat the type of security it's going to. It loses its status, for instance, as available for sale or held to maturity. It loses that status, and it is now considered trading, so we handle it as if it was trading all along. We make those adjustments that we would for a trading security. Now, if it transfers from trading to either the other, the key thing is there shouldn't be any unrealized gain or loss because we've already been reporting that in net income, so there is no unrealized gain or loss to worry about now. We've already marked it up to market, and we would do that at the point of the adjustment as well. So that day it's already at market. There's nothing left to adjust. If we go from held to maturity to available for sale, remember, under available for sale, we're not taking this to income. Instead, we're putting it in that OCI, that other comprehensive income statement. And if we take it from available for sale to held to maturity, what we're going to do here is we're going to take it back under the held to maturity rules, which say we amortize that cost. We don't write off anything right up front. We don't take anything to income or other comprehensive income. Instead, we amortize whatever gain or loss there is, and we amortize that over the life of that debt or equity security. So we've been talking about mark-to-market, adjusting up, adjusting down. Now, that's just normal day-to-day market issues. There are some times, though, that you're going to have such a severe impairment of the investment that it's not going to be a temporary investment. So, for example, or it's not going to be a temporary change. We want to recognize it as more permanent. So what happens here for both held to maturity and available for sale investments, we're going to take a look at that, and if we do determine that there is an other than temporary decline, then we're going to recognize that, even though we normally would not have if it was held to maturity or available for sale. Remember, usually we put that, if it's held to maturity, we don't recognize it at all. If it's available for sale, we put that other comprehensive income. We're saying here is that if this is other than temporary, we want to record this in earnings as soon as possible. Now, we're not going to get into how to determine that something is other than temporary. Basically, we're going to be told that, or we're going to be told it's not. Once we find that out, then we're going to put that in there. In this case, they're saying after the OTT impairment has been recognized, and that's the only impairment there is, then we can go back to treating the unrealized gains and losses as we normally would have. This slide just briefly talks about some of the things that you need to disclose on the financial statements. What is the aggregate fair value of all your investments? That needs to be disclosed. What is the gross realized and unrealized holding gains and losses? We saw the amount on the income statement lumped into one. You could have it separately, but we're going to want to see these lumped together as well. Maturities of your debt securities, we need to know how current something is or how long-term something is. So what are the maturity dates? We need to know the amortized cost basis by major security type for all those investments that we had. We need to know any changes in net unrealized holding gains and losses. We need to know the inputs to fair value estimates. So in other words, how are we estimating this fair market value? So now we're going to go on to, we talked a lot about when they lack significant influence. That's the majority of this particular course. but we're also going to talk about when they do have significant influence. So here, this is when they have between 20 and 50%. We're not going to use one of those three methods we talked about earlier. Instead, we're going to talk about the equity method. Here, we're basically taking a look at what we own, and that's what we're going to account for. So, for instance, if we have earnings from the investee, dividends, we're going to record that appropriately. Again, just the portion that we own. So if we lack significant influence, again, we're generally going to use, we've talked about that. If we have significant influence, we're going to use what's called the equity method. If we have control, we're going to consolidate. What happens when we consolidate is we report everything as ours, even though we may only owe 55%. It's not all ours, but we record it as if it was all of ours, and then we back out the portion that's not ours. That's kind of consolidation. But for now, we're going to talk about equity, where we only record the portion of it that we own. It could be 20, 30, 40, or 50%. Whatever portion we own, that's what we record in our investment account. So here we have an example. Well, here's an example of when the percentages, the bright line percentages, aren't always used. So here we say if we have more than 20%, normally we would assume that, hey, they have significant influence. However, there are a few different exemptions to this where we don't have to treat them as the equity method. If the investee challenges the investor's ability to exercise significant influence, so if they sue the investor through litigation or other methods to challenge that, to pretty much prove that you do not have the right to exercise significant influence, then that might be a situation where they're not going to have significant influence. The courts have already proven that. If the investor contractually surrenders significant shareholder rights, so even though they own more than 20%, they've given away a lot of their rights as an owner of 20% or more. If the investor just doesn't have a whole lot of information about the investee in order to apply the equity method, they can't get all the information they need to do that, then we won't use the equity method. And if the investor tries and fails to obtain representation on the board of directors of the investee, so if they cannot get anyone elected to represent them, then it appears that they must not have control. So that's just another way to do it. Again, under the equity method, it's actually rather simple. We're going to recognize investment income based on our percentage ownership. And then also we're going to recognize, well, the cash dividends, yeah, that's what's coming through here. So we're going to recognize the income itself. We're not going to take a look at the cash dividends instead. So what happens here is we record the investment at cost, and then it gets changed. That investment account changes over time. Now, what I said earlier was that we're recognizing income based on our percentage of the ownership. So dividends, normally under a company, dividends would be the way we represent income. Here we're saying, no, we're not doing it that way. We're not going to count dividends as our income. Instead, we're going to count whatever percentage of the overall company's net income, regardless of whether they distribute it as dividends or not. That's the key thing there. So what happens is when they record income, we're going to increase our asset, our investment, just as if they distributed every single cent of income out as dividends. That's kind of the assumption there. That's how it'll make sense. So that increases our account because, hey, the company's growing. That's kind of what's going on. They're growing, whether or not they give us that money as a dividend or whether they keep it internally to grow the company, it still increases our investment. Now, dividends that are actually paid out, we do not want to record those. That's not a good thing under the equity method. That decreases the actual investment that we have. So the big thing that increases our investment is our percentage of the actual net income that's coming. So here we have an example. On January 1st, 2011, Wilmer acquired 45% of the equity securities of Apex for $1,350,000. On that date, Apex's net assets had a fair value of $3 million. During 2011, Apex paid cash dividends of $150,000, and they reported net income of $1,750,000. What amount will Wilmer Incorporated report on the balance sheet as their investment in Apex on December 31st, 2011? So notice we start off with $1.3 million. That's how much we paid. And then the cash dividends, those are going to, dollar for dollar, those are going to reduce this asset balance, and our percentage of the net income, 45% of that, is going to increase it. Oh, and the one thing, yeah, we know, luckily there was no gain or loss. Going back a second, they talk about on that date the fair value was $3 million. Luckily in this case, $3 million times 45% equals that $1.35 million. So we paid exactly what the fair market value said we should. If we paid more or less, let's say we paid more, then we have a situation of goodwill. We'll talk about that a little bit later. But in any case, our first entry, we record the investment with a debit. It's $1.35 million. We credit cash because we're paying that amount. And then we increase our investment account based on our percentage of the revenue for that year, or the income, net income. So there was 1.75 million reported earnings that year. Our share of it was 45%. That's where we get the 787,000. So we debit the investment because that's good for our asset. That increases the value of the company. Thus, it increases our share of the company. And then we credit investment revenue. That's how we recognize revenue. It's, again, we assume, or we treat it just as if the company paid out dividends for every dollar of income they made. Now, when we look at the actual dividends, we're saying that's a bad thing because now that value is not kept in the company. Instead, it's been distributed out. So we debit cash for the actual money because we did receive it. So you can't really say it's all a bad thing. We did receive the cash. First of all, $150,000 was the total dividends, times 45%, which is our share. That's $67,500. So we debit cash because we received it. We credit the investment because that reduces the remaining value of our investment. It's just like we've withdrawn from our investment because that's exactly what we've done. And here's what the account looks like. So the answer to that question would be $2.07 million. That's what our balance would be at the end of the year. And we'll take a look at another situation. Wilmer purchased 25% of the common stock of Apex for $180,000. At that date, the book value of the net assets was $400,000, and the fair value of these assets is $600,000. So right away, this is the situation of goodwill that we had. We paid more than it was actually worth. So during 2011, Apex paid cash dividends of $40,000 and reported earnings of $100,000. Those are going to be our normal adjustments. We go back here. Oh, I'm sorry. In this case, they're saying it's not goodwill. They're telling us that, to make sure this is the same one. Yeah, they're telling us that difference is attributable to depreciable assets with a remaining life of 20 years, and 25% of it's for land, so we can't depreciate that. So what we're going to do is we're going to take the difference between the fair value and the book value. That's going to be, and we multiply that times the 25%, because that's how many of the assets we've purchased. That was our share, if you remember from earlier. That's our percentage ownership. It's just coincidentally the same percentage as the land, but that doesn't matter. That's just a coincidence. So the excess that we get is $50,000. That's how much excess we have to worry about. 25% of that is land, which we can depreciate. 75% of that, the remaining $37,500, that's the building or the depreciable assets, which we can depreciate. So what that's going to do is we're going to basically depreciate that over the 20-year life. So we get an additional 1875 depreciation. So how we handle that, first of all, we debit our investment account for $180,000, credit the cash because we paid cash. Then we received a dividend for our share was $10,000. So we have cash because we received it. We credit the investment because that reduces the value of our share of the investment because it's almost like we've withdrawn from the company. Then we turn around and we debit the investment for $25,000. That's our share of the net income, and we credit investment revenue for that same amount. And then down here, what we're doing is we're treating that depreciation expense as a debit to revenue. So instead of recognizing that as expense, because it's not really we can't record the expense because we're not Apex, that company themselves. So we have to instead record that as a reduction to our revenue from that company. So instead of debiting the expense, we credit the revenue. It has the same impact. It reduces overall net income. And of course, that hurts our investment in the company by $1875 as well. So we may have a situation where we change from equity to one other method, either the consolidation method or one of our earlier methods we discussed, based on how much we own at any particular time. So whatever the carrying value of the investment is under that equity, we're going to convert that to cost at that transfer date. So that's the big thing there. We're just going to act just as if we purchased that right then and there. So whatever that carrying value is, it's almost like we paid that amount in a separate transaction. That's kind of how we're recording that. And what we have to do also, remember how we've been recording all that net income as an investment to our account? We've been treating it as if they paid out every dollar of net income in the form of a dividend. We really know that they haven't done that. So what we have to do is we have to adjust for any of those undistributed earnings. So we take the reported earnings since the original investment started. We take out any dividends they paid over that time, and the remainder is the undistributed earnings. So we have to adjust those out. We counted them as a good thing, but in reality we haven't recognized anything yet, so we have to back those amounts out. And of course, when we're changing from the equity, or when we're changing to the equity method, we have to close out any of those temporary accounts we had set up earlier. Remember how we had that valuation account, we had that unrealized holding gain or loss. We have to close those out, and we have to do the reverse. Now what we're going to do is we're going to say, let's take a look at all those earnings that were really part of ours, part of our percentage of the ownership. We have to take a look at that, and we have to record that. They're talking about a retroactive change here. So it's the reverse of the adjustment that we just talked about, where we backed out the undistributed earnings. Now we're going to add in the undistributed earnings. So for this particular slide, we're really talking about that fair value option. I've kind of alluded to this already. And really at this point, there's not a whole lot of information that we can talk about here. Again, this has to be disclosed. What is the fair value? What were the inputs to that fair value calculation? How did you determine it? Briefly, I guess we'll talk about the difference between normal financial instruments and investment derivatives. Financial instruments, cash is the most common. It's one we don't even think of as an instrument, but the reason it's an instrument is because we can transfer it. Evidence of an ownership interest in an entity. So what we're saying here is stock, generally. And certain contracts can be financial instruments. If you've taken business law, talked about negotiable instruments, negotiable contracts, that's pretty much the same thing there. Now, investment derivatives. So all these financial instruments, they have a value all in their own. Investment derivatives, however, they don't have their own value. Instead, their value is derived. That's where the term derivative comes from. It's derived from the underlying security. So what we're saying here is we have a derivative that's going to move up or down based on some other stock. The derivative doesn't have any value. There's nothing really going on with the derivative. It's not recognizing any company. It's not recognizing any value. It's purely recognizing another financial instrument. The reason for derivatives, other than to really convolute investments by themselves, is to hedge risks created by other investments. So you could have a derivative that works against one of your investments. Now you might question, why do you want to work against it? In an upside, when you have upside potential, yeah, certainly you'd rather not have to work against it. You'd rather take all the gain. But the problem is the gain you're getting from your core investment is going to be offset partially by the derivative, which would have a loss at that point. So yeah, that's not the best thing. But on the flip side, when you have a loss on your core investment, which could be a big loss, you're going to have a gain on your derivative. It's not going to be enough to offset it completely, but it's going to be enough to hedge against it. So the whole purpose, really, the big reason for derivatives is to hedge, to offset some of the risk that you're incurring with your normal investments.